G'day Gain Squad, welcome back to the channel where we track the shiny stuff and the macro madness. I am your host at Goldie Gains. Let's see where the smart money is flowing today. We're unpacking the massive volatility from the 1971 Nixon Shock all the way to our current 2026 chaos. We are checking how oil crises in the 70s and the current war in Iran move the needle for gold, silver, and copper. And we will project what your house and groceries would actually cost today if we still had a $35 gold peg. Before we optimize this entry, remember this is for education and entertainment, not specific financial advice for your portfolio. The big question: if you could time travel back to 1971, are you stacking gold bars or buying a beach shack? Tell me in the comments, and while you're there, smash the like and hit subscribe to join our community of gold getters. Let's get into it, because the markets today look exactly like they did in the past. We have to start on August 15, 1971, when President Nixon officially ended the gold standard and shocked the world. Before that, the world was on the Bretton Woods system, where $35 was equal to 1 ounce of gold. But the US was spending heaps on the Vietnam War and social programs, printing more dollars than they had gold for. Central banks in places like France got nervous and started swapping their paper dollars for physical gold bars from the vaults. By the time Nixon acted, US gold reserves had plummeted from $24 billion down to less than $10 billion. Nixon closed the gold window temporarily, but it's been over 50 years and the window is still slammed shut, mate. Ray Dalio was a 22-year-old clerk on the New York Stock Exchange floor that day, and he expected total pandemonium. He thought stocks would tank, but they actually jumped 4% because the currency devaluation made nominal prices look higher. This was a classic currency devaluation, and it's a proper golden entry for anyone who understood the history of fiat money. Once gold was free from the $35 peg, it didn't just walk, it sprinted like a skip in the outback. It went from $40 in early 1971 to nearly $70 per ounce within a single year of floating. By 1973, it tripled the old fixed rate, hitting over $120 as inflation began to bite. Copper was also feeling the heat, moving from about 64 cents a pound in 1971 to over $1.40. In 1973, the first oil shock hit when the Arab members of OPEC cut production and prices quadrupled. Oil went from $3 to nearly $12 a barrel, and gold proved itself as the ultimate hedge against energy costs. Silver followed along for the ride, surging from $1.50 in 1970 to over $6 by '74. But the real fireworks started in 1979 with the Iranian Revolution and the second major global oil crisis. The world watched as oil prices soared from $13 to over $34 a barrel, sparking genuine economic panic. Gold went parabolic, racing from $230 in 1979 to $850 in January '80. If you held gold from 1971 to 1980, you made a massive gain of over 2,300%. Those who kept their savings in paper cash lost 87% of their purchasing power to the inflation monster during that time. Silver hit a peak of $49 an ounce in 1980, partly thanks to the Hunt brothers trying to corner it. The gold to silver ratio dropped to 17-1 in January 1980, showing just how much silver can outperform. Now fast forward to our current 2026 crisis, where history is rhyming in a very scary and expensive way. The war in Iran and the closure of the Strait of Hormuz has triggered the largest supply disruption in modern history. Brent crude has surged past $120 per barrel, and some analysts say $170 is next. We are looking at a supply deficit of 6 million barrels per day, which is absolutely gutting for the global economy. Qatari liquefied natural gas is offline, and spot prices in Asia have increased by over 140% recently. This energy shock is a proper wobbler for the markets, and it has sent gold to a fresh all-time nominal record. In late January 2026, gold hit $5,598 an ounce, which is truly a golden entry. Silver has also rocketed to $76 an ounce, gaining 6% in single sessions during the peak of the panic. Copper is holding strong around $5.71 a pound, reflecting its role in the global industrial machine. Ray Dalio says this moment feels just like the early 70s, with high debt, high spending, and massive currency devaluations. He warns that we are in the late stage of a big debt cycle, and the US debt is approaching $38 trillion. Dalio recommends smart money keeps up to 15% of their portfolio in gold as a diversifier against systemic risks. He says gold is the only asset you can hold that doesn't rely on someone else's promise to pay you back. But Warren Buffett still isn't a fan, calling gold a lifeless asset that just sits there and looks at you. Buffett prefers a goose that lays eggs, like a productive business that can hike prices when the cost of living jumps. Back in the 70s, he bought See's candies and watched them raise prices from under $2 to over $5. See's was an asset-light business that could absorb inflation, while gold miners often struggle with rising fuel and labour costs. Buffett says gold is a way of going long on fear, and you have to hope people get more afraid later. Benjamin Graham, the father of value investing, was also a skeptic, noting that gold often failed to protect against dollar losses. But traders, remember that Graham died in 1976 and missed the massive $8,500 gold moonshot. Also, for most of his life, it was actually illegal for Americans to own more than a tiny bit of gold. Today, gold has surpassed the euro to become the second largest asset in central bank reserves, right behind the dollar. This is a massive structural shift in the world order, and it shows that the big players are hedging their bets. Let's look at your actual purchasing power, because the nominal prices we see in dollars are a bit of a deception. In 1971, a median house in America was about $24,300, which sounds like a total bargain. With gold at $35, that house cost about 694 ounces of pure gold back then. Today, that median house is about $445,000, but let's measure it in gold ounces instead. With gold around 5,500, that same house only costs 81 ounces of gold in 2026. That means in real gold terms, the price of a house has crashed since 1971. A new car was about $3,500 in 1971, or about 100 ounces of gold. Now, a $50,000 car only costs about 9 ounces of gold, which is a massive win for savers. Even airfare has dropped from 1.3 ounces of gold per ticket to less than 0.07 ounces. It is clear that gold is actually undervalued even at $5,000 today, because everything we buy is actually cheaper today than in 1971. The technology and productivity of the world have made things cheaper, but the currency expansion has hidden that progress. The US M2 money supply has grown from $600 billion in 1971 to over $22 trillion today. That is a 38 times increase in the amount of dollars, while global gold production has only about doubled. Now, let's look at a hypothetical world where the $35 gold peg actually remained in place until 2026. Based on the current gold ounce cost of assets, a median house would only cost you $2,800. A brand new car would be about $315, which is less than a fancy Sydney dinner. A domestic flight would cost you about $2.45, basically the price of a small coffee. And a gallon of milk would be priced at less than 3 cents, which sounds absolutely mental to us today. These numbers show just how much the full faith and credit of fiat currency has diluted our hard-earned savings. We invented money printing because we got addicted to debt, and the debt wall of 2028 is fast approaching. The 2026 Iran war has shown that our global economy is still hopelessly reliant on fossil fuel supply chains. Fertilizer prices are up 20%, which is going to push global food prices up by at least 6%. This is leading to record levels of food insecurity, with 45 million more people facing acute hunger worldwide. For us gold getters, this stagflationary environment is the perfect storm that gold was literally made for. Central banks are buying gold at the highest rates in over 50 years to protect their national sovereignty and reserves. Unlike the 1980s, the Fed can't just raise rates to 20% because the debt service would be lethal. Every rate hike today magnifies the fiscal bleed on a $37 trillion deficit, creating a debt death spiral. Dalio calls it a debt-induced heart attack, and it makes gold look like the only safe haven left standing. We are seeing a divergence where industrial metals like copper might struggle if the global economy slows down too much. But gold doesn't care about industrial demand as much as it cares about the trust deficit in paper money. Silver is the wild card, as it's both a monetary metal and an industrial metal needed for solar and tech. The gold to silver ratio is currently widened, which historically suggests silver might be due for a massive catch-up. But silver is way more volatile, so you have to keep your positions tight and your eyes on the charts. In 1971, the Australian dollar to US dollar pair was a very different beast before we floated. Now we are exposed to every global shock, and the current war is a proper test for our local economy. If the Strait of Hormuz stays closed, we could see petrol prices at the pump hit record highs in Sydney. This will feed into the cost of everything from your morning smashed Avo to your next interstate flight. But remember, the smart money is always looking for the golden entry during periods of maximum fear and panic. We are living through a transition period that only happens once in a lifetime, according to Ray Dalio's research. It's a shift from a dollar-dominated world to a more fragmented system where hard assets are the ultimate anchor. Whether you are a fan of Buffett's productive geese or Dalio's golden bars, you need to be diversified. Inflation is the invisible tax that eats your capital while you are busy working your 9 to 5. Nominal gains in your house price don't mean much if you can't buy as much gold or food with the profit. Real wealth is about what your money can actually buy, not just the number of zeros in your bank account. The 1970s showed us that gold can go from 35 to 850 when trust disappears. In 2026, we've already seen it go from 4,000 to 5,500 in a few months. Gold is timeless. It always has value. The value of fiat paper money can change rapidly based on global trust. But gold is the original trustless currency. You have it, you have value. Keep your head on straight, don't follow the herd, and focus on assets that have stood the test of time. Gold has been money for thousands of years, while every fiat currency in history has eventually gone to zero. We are seeing the return of hard money as the world realizes you can't print your way to true prosperity. The projections for a $35 gold world seem like a fantasy, but they are a mathematical reality of devaluation. If we want to preserve our gains, we have to understand these big cycles and how they affect our local wallet. The cost of living crisis in Australia is just a symptom of the global monetary experiment that started in '71. We are all participating in this experiment, whether we like it or not, so we might as well play it smart. Stacking physical, buying miners, or just tracking the macro, whatever your strategy, stay active and stay informed. The war in Iran is a tragic event, and its economic ripple effects will be felt for years, not just months. Supply chains are being reshaped, and energy security is now the #1 priority for every major nation. Gold remains the one thing that no government can print, devalue, or easily manipulate over the long run. This is a proper golden entry into a new era of finance, and I'm glad you're here with the squad to track it. To recap, the 1971 Nixon Shock ended the gold standard and unleashed 50 years of massive inflation. Gold surged 2,300% in the 70s as oil crises sent the global economy into a tailspin. The 2026 Iran war is a modern-day replay, pushing gold past $5,500 an ounce. Ray Dalio recommends a 15% gold allocation, while Warren Buffett prefers businesses with massive pricing power. If we measure the world in gold, housing and cars have actually become much cheaper than they were in 1971. If the $35 peg still existed, you could buy a house for less than $3,000 today. The expansion of the M2 money supply is the real driver behind the high prices we see at the checkout. So traders, what is your next move? Are you hedging with gold or betting on a massive market recovery? Let me know if you think gold is going to hit $10,000 or if this war will settle down soon. Chuck a comment below, smash that like button, and subscribe to Goldie Gains so you never miss a golden entry. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!